If you ignore ETFs today, you will regret it by 2030. Mutual funds are old school. ETFs are cheaper, faster, globally flexible, and used by the smartest wealth builders today. And if you start early, they can quietly transform your financial life through low cost and compounding. In this video, you will discover the top 5 ETFs that can help you build serious wealth by 2030. The 5 key metrics every smart investor checks before buying any ETF, and a 10,000 monthly SIP allocation you can copy as your own Crorepati formula. But stay with me till the end, because even a small allocation mistake can make out years of returns. And remember, this is not financial advice, just my personal research and conviction. Let's begin. First, let's see ETF and mutual funds, the quick difference. Let's start with the basics. Mutual funds are actively managed. A fund manager picks the stocks, tries to beat the market, and you pay higher fees. Whereas ETFs or exchange traded funds are mostly passive. They simply track an index like the Nifty 50 or Nasdaq 100 and charge much lower fees. You can buy and sell ETFs anytime on the stock exchange, just like a share. And since the expense ratios are much lower, often below 0.85% per year, you save a lot over time. So if mutual funds were the 2010 story, ETFs are definitely the 2030 story. Next, let's see the 5 metrics that matter. Before we dive into the list, here are 5 simple numbers you must check before you buy any ETF. First one is expense ratio. How much the fund charges you yearly, lower is always better. Next, AUM and liquidity. Higher assets under management, AUM, and active trading volume make entry and exit easier. Next, tracking error. How closely the ETF mirrors its index. The smaller the better. Next, historical returns and risk. Look at the long-term CAGR and volatility, not just 1-year returns. Lastly, underlying index or exposure. What the ETF actually holds. Large cap, mid cap, gold, or global stocks. Keep these 5 metrics in your checklist because they decide how efficiently your ETF will perform over time. Now let's go to the exciting part, the 5 ETFs I believe can help you build a diversified futuristic portfolio for 2030. The first one, Core India Large Cap ETF, UTA BSE Sensex ETF. You can do 40% allocation. This is your foundation, your core. The expense ratio is just 0.05% per year, one of the lowest in India. It has an AUM of around 49,000 crore, and since it tracks the S&P BSE Sensex, liquidity is excellent. Tight bid ask spreads and huge trading volume. Here the tracking error is barely 0.01%, which means it mirrors the Sensex almost perfectly. In terms of returns, since inception in 2015, it's delivered a CAGR of around 13.7%. Of course, there is a market risk. Large caps fall when the market falls, but over time they recover very strong. And the underlying index is India's 30 largest companies, the country's financial engine. So this is your core strength ETF, stability, scale, and long-term compounding. The next one, global tech exposure, Motilal Oswal Nasdaq 100 ETF. You can do 25% of allocation. If India is your core, the US tech sector is your growth booster. The expense ratio here is about 0.58% per year. It has an AUM of around 10,800 crore, making it one of the India's largest global ETFs. Here liquidity is strong with minimal bid-ask spreads and consistent trading volume. Its tracking error is not publicly large. Being a direct tracker of Nasdaq 100 index, it's efficient. Historically, it's delivered a CAGR of around 23% since 2011, thanks to global tech powerhouses like Apple, Microsoft, Nvidia, and Amazon. Yes, the risk is higher because of currency movements and global volatility, but the underlying exposure, the Nasdaq 100, represents the world's innovation leaders. This is your growth rocket. Now let's see the next ETF, India's future large caps, Nippon India ETF Nifty Next 50 Junior Bs. You can do 15% allocation. This ETF captures the next 50 companies below Nifty 50, essentially tomorrow's potential large caps. Here the expense ratio is just 0.17%. It's very low. It has an AUM of around 6,600 crores. offering healthy size and liquidity. The tracking error is roughly 0.06%, indicating it follows the index very tightly. Over the last 5 years, this ETF has returned a CAGR of nearly 21% according to Nippon's official data. Here, risk is moderate to high. These are emerging companies that can outperform or underperform, but the underlying index Nifty Next 50 gives exposure to future market leaders across sectors. So this ETF gives you that booster engine in your wealth plan. Now take a deep breath. Let's go to the next ETF. India Mid Cap ETF. Nippon India ETF Nifty Mid Cap 150. You can do 10% of allocation. Mid caps are like the Indian market's growth laboratory. More risk but often high reward. The expense ratio is about 0.21%. It manages an AUM of nearly 2,700 crore and liquidity is decent. Volumes are rising every month as investor interest grows. Here the tracking error is around 0.09% according to the peer data ticker tape. In terms of historical performance since 2019, this ETF has compounded around 21.5 CAGR, reflecting India's mid-cap boom. The risk, however, is high. Mid-cap falls sharply during corrections. Its underlying index, the Nifty Mid-Cap 150, gives you access to roughly the 101 to 250th largest Indian companies. Agile, fast-growing and future-focused. Use it as a 10% growth satellite. Don't over-allocate. And finally, pause and remember this. This last ETF quietly rises even everything else crashes. Gold ETF, Nippon India ETF Gold Bees. You can do 10% of allocation. Finally, a hedge. Gold protects you when equity falls. The expense ratio is around 0.80%, slightly higher than equity ETFs because of storage and custodian costs. The AUM stands at roughly 29,000 crore, making it one of the India's biggest gold ETFs, and liquidity is excellent. Here the tracking error is minimal as it directly tracks the domestic price of physical gold. Historically, gold has acted as a hedge, not for growth but for stability. During inflation or market crashes, gold ETF often rise. It has given a 5-year CAGR of around 18%. The underlying exposure is pure gold bullion, giving you inflation protection and diversification. So while this ETF won't make you rich overnight, it will keep your wealth safe when market turns stormy. Now comment below which ETF do you want me to analyze next. Your comment helps this reach more investors. Now let's see the final part, the 10,000 SIP allocation. Now if you want a simple practical plan to start, 4,000 rupees in UTA Sensex ETF large cap core. Next you can invest 2,500 rupees in Motilal Oswal Nasdaq 100 ETF for global tech growth, and 1,500 in Nippon Nifty Next 50 ETF future large caps, and 1,000 in Nippon Mid Cap 150 ETF growth booster, and 1,000 in Gold Bees ETF hedge and protection. If you invest 10,000 a month for 10 years at an average 12% CAGR, your corpus could reach around 20 lakhs rupees. At 14% returns, it jumps closer to 25 lakhs. That's how slow, consistent investing creates wealth. Not luck, just compounding and discipline. Now let's see the bonus part, future trend prediction. Why this formula works. 3 key trends will define 2030. First, India's domestic growth, formalization, consumption and manufacturing will lift large and mid-cap stocks. Second, global tech, AI, cloud and semiconductors will remain innovation hubs, and through the Nasdaq ETF, you participate globally. Third, inflation and hedging. Gold will continue to protect against currency devaluation and volatility. Together, these trends make your portfolio balanced. Growth, protection and global diversification all through ETFs. So here's your Crorepati formula in one line. Low cost ETFs, consistent SIP, long-term patience. If you ignore ETFs now, and you will spend the next decade watching others build wealth. Before you invest, quickly check expense ratio, AUM and liquidity, tracking error, historical returns and index exposure. Always stick to the trusted AMCs. Rebalance yearly and never panic trade. This is not advice, it's a smarter way to think about wealth. Always research before investing. It's your hard-earned money. If you found value, like, share and subscribe, because the next decade belongs to disciplined ETF investors. Now that you know the smartest ETFs for long-term wealth, watch this next video on 5 Indian stocks you will regret missing in 2026. This is how smart investors add extra growth on top of ETFs. I will see you there. This is Bala signing off.